Right, may seem strange using a microphone for 7 people, but it's for the camera, so I have to do it. I also need to pretend there's a lot more people in the room, so in my jokes, if you could laugh a lot louder than normal, that would be much appreciated. Standing ovations are good as well. Cool, so we get kicked off. I appreciate you being on time. Like I said, it's not a WBAF tradition to start things promptly, but we'll get going. What I'll do is I'll try and get through the content relatively quickly, because this is sort of billed as a workshop, so that we have at least sort of 15, 20 minutes to sort of Q&A and discuss it. Because I know it's from what I've seen already, it's a pretty diverse room. So I think rather than me trying to guess what elements of it you're interested in, if you can just ask the questions based on what appeals to you guys. So I guess this is called entrepreneurial investing. What I'm going to share with you is the way that we approach investing in an entrepreneurial way. Whether that fits with your model, your experience, is kind of less important than hopefully encouraging you or inspiring you in some way to look outside some of the traditional ways of investing and exiting. We kind of arrived at this by challenging some of the status quos and realized that actually there are some more effective ways to invest and to exit. So this is just one way of doing it, but it's really to kind of show you that actually if you push hard enough, there's some quite interesting options that people don't know about. We just do a quick show of hands. Who in the room is an investor? Okay, about half the room. Who in the room is an entrepreneur? Okay. Who in the room, is it too early to raise your hand? Okay, so I'm going to be sort of flipping back and forth between talking about this from an entrepreneurial perspective, as a business owner perspective, and as an investor perspective, because we're kind of, you need to look at it from both sides for this to work, which is a problem because typically investors have no idea what entrepreneurs are talking about and entrepreneurs have no idea what investors are talking about. So we're going to try and merge those two things. And I want to share a story. It's just a quick one. Who's raised money? Who's gone out and tried to raise money before? All right. Lots of depressed looking people. Okay. As you know, it's a pretty painful and soul destroying experience. And a lot of this process started, I have a very good friend of mine in Hong Kong, a woman called Liz. She runs a media company. She's been in publications, editors of significant magazines and things for about 20 years. So hugely well respected in her industry. She's a named person. Everyone in the industry knows who she is. She had a situation where her company, which was doing well, it was doing about 5 million in revenue, about 1 million in profit. She had an opportunity through one of her clients to expand it significantly. But she needed about 3 million in capital in order to do that expansion. Pretty familiar story to a lot of us. And now it gets romantic. So pretty familiar story. She went from being well known in the publishing industry to being a complete newbie in the investor world. And she went and she did everything that all the lists tell you to do. She sent out emails to venture cap. It's a disco. Right. Everyone happy? Good. She went out, she spoke to venture capitals, and she spoke to private equity, and she spoke to angels, and basically, she wasn't talking their language. And actually, especially if you don't know what you're doing, even if you do know what you're doing, it can be pretty soul-destroying. You know, venture capital will say to you, yeah, come and send us your business plan, we'd love to invest in you. And then you turn up as this 20, 30 year veteran of your industry, and you're met with some 22-year-old with an MBA who thinks they know more about your industry than you do, and has been taught one phrase, which is, what is your USP? What's your unique set? And beyond that, they don't really care. So it's a hugely soul-destroying experience. Liz was telling me about this, and she was close to tears because it was just, she'd spent 6 months being rejected by people that just couldn't see the opportunity that she could see. And I left that meeting thinking, you know, there has to be a better way of doing this. There's got to be a better way of connecting capital with the people that create the value in the world. Because ultimately 50%, and this has been banded around a few times, but 50% of the world's GDP is created by small businesses. In many countries, 90% of private sector employment comes from small businesses. And yet there's trillions and trillions of sophisticated capital that won't go near the SME space, can't go near the SME space, because it's illiquid and it's risky and it just doesn't, if you're a fund and your ticket size is 100 million, you can't put that into Liz's $5 million business, it would break. In fact, in Warren Buffett's book, Snowball, he says the biggest challenge he has is that he has to deploy $100 million a week every single week, and there's just not that many companies that can cope with that. It's a problem to have, you know. Anyway, so this is kind of where it started from. It came from this angle of, okay, how do we solve this problem for small business owners? So, quick background on myself. So I've been an entrepreneur for 20 plus years. Actually started off making and selling ice cream when I was like 12 years old and kind of hustled on from there. I've written a couple of books on the model. If anyone gives me their business card, I'm happy to send you copies of those. This is the Bald Appreciation Society that myself and Baybars set up last year. This was us signing an MOU for a fund, which I'll talk about later. I do some TV stuff. I've also done a series of interviews with entrepreneurs and investors, and have published interviews with 800 entrepreneurs and investors over the last few years, which kind of gives you quite a lot of insight into the way people think. That was Times Square, a 5-story building. The first time we listed a public company. It was the fastest growing IPO in 2016, and so they invited us to Times Square, and that was on the billboard when you arrived in Times Square. Pretty good for the ego. We then destroyed $250 million in market value, which I'll share with you later as well. Not quite so good for the ego. And the little penguin is my attempt to be young and hip. I sit on the board of advisors for an e-gaming company in Poland called Kingwin. It's doing 100 million in revenue and does all sorts of cool stuff that I don't understand. So that's myself. Yeah, basically 20-year veteran of entrepreneurship, and about 10 years I've been investing. And to be honest, most of that first 10 years, or most of the first half of that 10 years, I was a really bad investor. All the things that make you good as an entrepreneurship, that insane enthusiasm and belief that everything will work out, is just not a very useful trait as an investor. So I used to do all these investments and just go, yeah, but look, it could be so good, without looking at the downside. So what I discovered as my investing process evolved was that I was looking for 3 key things, and they say like minds attract, and basically what's happened is we've attracted investors that are after these 3 things as well. So first one is alpha, which is Wall Street speak for profit. It's overperforming the market. So everyone wants to overperform the market. They want alpha. I wanted impact. When you become wealthy and you start getting offered all of these investment products, there's all sorts of very clever derivatives and debt products and all of these kind of things, which are great, but you basically give them their money. You give them your money, and then it sort of disappears into a black hole, and you don't really see any impact from the money that you give. Whereas if you invest in a small business, you know that money is going to create jobs and create value for customers. And so for me, I wasn't happy just chucking my money into a fund and not knowing where it wanted. I wanted to make some impact. I wanted to see where that money was going. And the third one was liquidity. And I think liquidity is even more important if you come from an entrepreneurial background, because entrepreneurs see opportunities everywhere. And so if your money is locked up for a long period of time, the opportunity cost, real or imagined, is incredibly painful. And again, liquidity, for those not know, is just your ability to withdraw cash quickly. So if you buy a property, you can't sell bricks for cash to pay for coffee when you need it. Your money is locked up in that business, it's in that property. It's very illiquid. So those are the three things that I was looking for. Those are the three things that all of the investors we work with are typically looking for. But that's a bit tricky. So how do you find that sweet spot in the middle of those three things? Well, let me offend people in the room now. If you're just interested in making impact, then being an angel investor is a really worthy thing to do. You can make a really significant difference in startups' lives by putting money in. That money goes directly into building the business, creating jobs, creating value for customers. It's hugely powerful as an impact strategy. However, it's not particularly good at creating alpha. It's not particularly good at creating returns. So I don't know if any of you saw Peter's presentation or his panel discussion group yesterday. So Peter, I think he's 2 or 3 time Angel of the Year in the UK. He's had 5 successful exits. It's pretty awesome. He still admits he's below water. He hasn't turned a profit on his angel investments because his 5 wins have been outweighed by the 9 losses, the companies that have failed, and the rest, he's got more than 50 investments that are locked up and he can't get access to. So, yes, there's a possibility that you're going to back the next Uber, but if you're working on probabilities, the chances of getting significant alpha are very, very low. And in fact, every significant angel investor I've seen around this environment has said, look, don't do it for the money. Do it for your own reasons. Do it because you want to give back to the community. Do it because you want to learn about that industry. Do it because you want to give your knowledge and time. But it's an expensive hobby. As an investment return, it's not particularly good. And it's also hideously illiquid. And this is one of the problems. So it's because the barriers to entry for angels is so low now, a lot of people go in with 10 or 20 grand, and then they're asking for their money back a year later. Well, it just doesn't work like that. I mean, even Peter was saying you need to be thinking 10 to 12 years to get your money out. Well, 10 to 12 years for me is a lifetime. That's there'll be flying cars and stuff by then. So that doesn't work. For liquidity, if you want liquidity, go and buy an Apple stock. You can buy an Apple stock now and you can sell it then. It's like very, very easy. You can get in and out as quickly as you like. That's great, and you can stick it into an ETF, and that will curb your base instincts to sell when it's low and buy when it's high. So it'll give you liquidity, but it doesn't give you impact. So I love Tesla. But if I buy shares in Tesla, that money doesn't go to support Elon's attempts to build electric cars. It goes to the person before me that sold me his shares. So Elon gets a secondary impact, but it's not a direct impact. It's also nearly impossible for an individual investor to consistently outplay the market. We all think we can, but it's statistically it very rarely happens. And then there's alpha. Do we have anyone in private equity in the room? Or can I really tear into private equity? So typically, it's been seen that if you invest in private equity, that's a great way to get a return. And private equity did have its heyday about 20 years ago to about 10 years ago. And private equity, for those that don't know, it was basically borrowing huge amounts of money to buy a private company, saddle that company with debt, fire half the staff, and then flip it on to the next buyer. And if you're buying that company low enough and you can get a high enough exit, that's a very lucrative way to make money. The problem is, when anybody makes money in a real market, everyone piles into that market. So I heard about a month ago, there are 62 private equity companies in Manchester. For those of you that don't know, Manchester is a football team up in the north of England. It should not have 62 private equity firms in there. There are more private equity firms today than there's ever been. Last year, private equity raised more money than it's ever raised before, and yet it's already sitting on $1 trillion of dry capital. That means that they're sitting on this money that they can't find deals to do. And consequently, when you've got that many people with that much money trying to do deals, the price of the assets that they buy goes up and up and up because people have to show deals, and so they end up overpaying. So 20 years ago when private equity was doing deals, they were buying at 6 times EBITDA was the average. Last year it was 13 times EBITDA. So you're buying the same company, but you're paying more than double for it. And when your business model is based on borrowing in order to do that acquisition, and you're kind of betting that the interest rates aren't going to go up because they haven't gone up for the last 10 years, that's not a bet I want to take. But what I think you'll see in very short order is an awful lot of private businesses going bust over the next 2 or 3 years because they're saddled with so much debt. And the problem is private equity can't get out of that because even if you take it public, you might get 14 times EBITDA. Well, that's not that attractive a jump. Last year, 1/3 of all private equity transactions was private equity to private equity. What that means is they didn't sell it to an external party. They didn't sell it to the market. They sold it to their friends who have another private company. And they basically said, look, I'll sell you this company. You give me the cash. I'll pay my LP, my investors. I'll do another fundraise, which is how come they've raised more money than they've ever raised again. And then I'll buy 2 companies off you next year. So it's a money go round. So 1/3 of all transactions are private equity to private equity. Because you go out to your investors and you say, hey, look, I've just given you a return, but it's not a real return. The other thing that private equity can do is because they mark their own pricing, it's not publicly noted, they'll buy the company and then they'll tell you, the investor, it's going up every quarter in a very smooth, straight pattern, because that's how business works. So it looks great. They can kind of obfuscate it. It used to be, private equity used to be around 5 years. They would lock up investor capital. It's now nearer to 10. So 8 + 1 + 1 is the way they phrase it, but it's near 10 years now as they lock up your capital. Which again, that's a little bit of a long time. Now look, even if there was someone from private equity in the room that wanted to argue with me on that, I was kind of hoping there would be, but even the most ardent private equity fan in the world, they might argue that they're smarter than the other private equity so they can get you alpha. Nobody would ever admit or say that private equity has a positive impact on the businesses that they go into. There's so much data out there that shows that percentages of businesses doing better after private equity investment are negligible. Because generally, businesses don't do well under a huge amount of debt. You get a short-term boost when you fire all the staff. You get an EBIT rise, but it tends to go down very rapidly. So, having now insulted most of the people in the room, I'll move on. So, this is the kind of the problem. So, how do you then find something that sits in this middle that does good, directly impacts the businesses you want to, has liquidity, and gives you better than market returns? So the answer is pre-IPO. It's the only thing that we've found that actually ticks all 3 of those boxes. So the money goes directly into the company for its growth. It doesn't go out to investors because you're pre-IPO. You get liquid as soon as the company IPOs. And typically, you'll do significantly better than the market. So this is based over 25 years. With statistics, you can pick any time frame to prove the point you're trying to make, but it's I like to go with the longer the better. So over a 25-year period, the S&P 500 has done about 10%. So if you invest in the S&P 500, you can get in and out. It says 10 seconds. It's probably a fraction of a second if you're a high-frequency trader. But you can get around a 10% return on investment over 25 years if you just chuck your money into an S&P fund. Interestingly, if you go into small cap funds, you typically get about a 30% premium, but actually the liquidity is not as good in smaller stocks. But it's actually the same as private equity. So over a 25-year period, private equity kind of has some highs and lows, and we're about to go into, my view is we're about to go into low, but over time it works out at about 30% premium over the S&P, but it's not that, that's not that significant for locking up your money. If you are able to get pre-IPO stock and you sell on the first day of the IPO, averaged out, you'll make about 17.5%. not a bad return. If you hold on to it for a year, on average over 25 years, you'll make about 23.6% return, which is pretty attractive. So it's pretty obvious, like if you've got a choice of where shall I put my money, then trying to get hold of pre-IPO stock is a pretty good bet if you can do it. The problem is, how do you do it? How do you consistently get access to pre-IPO stock? So it's not talked about so much now, but if anyone remembers the dot-com boom, there was this whole kind of industry built up around those investment banks and everyone wanted to be the best client of the investment bank so they could get that pre-IPO stock. Because the investment bank would give it only to their select top clients, hype the stock, and you'd make a huge amount of money in that period. There's actually another way to get stock. So one way is that you become an investor early on, and if you're really early, you're an angel and you're kind of praying for an IPO. Sort of the more sophisticated approach would be to try and get in earlier. So pre-IPO could be that you're just doing a traditional IPO, but it could also be that you do a reverse into an existing business, which basically means an RTO, reverse takeover, means that a small business swaps its private stock for public stock and kind of gets swallowed up by the public stock, but your private stock now becomes public stock. So there's two ways that you could end up with a pre-IPO. So what we decided to do was to create our own vehicle in order to give us access to pre-IPO stock. So in order to explain this, I'll explain the fund first, and then I'll explain the vehicle that the fund invests into, and then I'll go back and we'll jump onto questions. So this is the way it works. So AVC stands for Accelerated Venture Capital. And basically, again, venture capital, like private equity, venture capital actually gets worse returns in general over time than private equity did. It did incredibly well in 99 to 2000. But hasn't done very well since then. It's underperformed the S&P. Also, venture capital, if you look at Silicon Valley venture capital, the average lockup now is 14 years. So the average venture capital fund in Silicon Valley is not returning money to its LPs for 14 years. And the reason that they're not is that there's just no exits. There's 50% less IPOs than there were 20 years ago. And there's just not enough exits. So we called it accelerated venture capital. We said, look, we don't want to tie up anyone's money for more than 12 months. 12 months is my kind of limit that I'm comfortable with. I'm not a very long-term thinker. So basically, accelerated venture capital gets investment from angels, from high net worths, from families, from funds, from institutions. It then invests capital into small businesses. And I'll talk about our criteria for what those businesses are. Later that day, those small businesses swap their private stock for public stock in a PLC. Now what this means is for the SME, they're getting all the advantages of going public. So they're getting scale, they're getting liquidity, they're getting all of the hype that goes with it. They're also sitting on a war chest, which means that once they start to get all of the bigger deals and opportunities that come to you, they actually have a war chest in order to go out and achieve it. What it means for the PLC is the PLC can announce to the marketplace, we've just acquired a small profitable business that's sitting on a pile of cash. And the way RTOs work is you're paying with script. So in effect what happens is this PLC will announce to the market, we just acquired $1 million of EBITDA and $3 million, hello, would you like me to start again? No, I'm just kidding. We just acquired $1 million of EBITDA and $3 million of net cash, and it cost us 7 or 8 million in stock, in script. Well, there is no other PLC in the world that can acquire cash and capital that cheaply. It just doesn't exist. Where it gets really interesting is what it means for this fund. So this fund invested $3 million in a small illiquid company in the morning. In the afternoon, it got its exit. It's now got liquid stock. So as soon as that share price starts to go up, it can start to draw down its investment and reinvest it into the next business. which is completely unheard of in any investment vehicle up to date. What it also means, which is something that I'm particularly fond of, is that this is all transparent. If I invest money in a private equity fund or a venture capital fund, they go and deploy that money into companies. I don't see anything that's going on in those companies. They get to choose the valuations that they assign to those companies. In this model, as an investor, you've got full transparency of, okay, $1 million went into this company, it came up here, the share price went up 7% on the announcement of the deal. We pulled out 10% of the money on day one at a 7% increase. We then reinvested that into the next business. So you have full transparency of what's going on in the money. At the end of 12 months, you can then either withdraw that cash or you can choose to take stock in the PLC, which is a high dividend yielding stock because it's sitting on an awful lot of cash. So it's a very interesting approach. But in order to understand it, you kind of really need to understand what's going on up here. So I know some of you were here last year, you've heard this, but I'll keep it relatively quick. But agglomeration is a model that we came up with, which is all of the elements of it have been done previously. I think we were the first people to put it all together, and the reason that we did it was because we came at it from an entrepreneurial point of view, which is how do you help the small business owners? So agglomeration is a publicly listed vehicle which exists solely for the benefit of good, well-run small businesses. They swap their private stock for public stock, but they keep full independence. So the founders, typically the founders, get to run their business the way they've been running it. It's their brand, it's their culture, it's their hiring and firing, which for the entrepreneurs in the room, you'll know it's very important because basically we don't make very good employees. We're not very good at being told what to do. And so we like running things the way we like to run them.
So Callum, is that PLC back and back?
So it basically starts off as a SPAC and then we back in the companies. Yeah, exactly. So a SPAC is a special purpose acquisition company. Interestingly, financial markets tend to go hot and cold on SPACs. So when they haven't got enough companies listing, they'll suddenly open it to SPACs, and lots of people put SPACs and then put in these really dodgy businesses, and then they shut it down to SPACs again. But if you control the SPAC, you can make sure the businesses going in fit your criteria. So it's not often you get to show a picture of an elephant making love on your PowerPoint, but my first business partner always used to say to me, elephants only mate with elephants. And what he meant was that most small businesses have in their business plan that we're just going to go and partner with Facebook or Microsoft or General Electric, maybe not General Electric now, but these big companies, and our businesses, we just need 1% of their budget and we'll be perfect. It doesn't work. Big companies can't work with small companies. They can't work nicely with small companies. So big companies need to work with big companies. Small businesses get stuck in what we call the scale paradox. And the scale paradox basically means you're too small to go for the really big contracts. Because you can't get the really big contracts, you remain small. And oftentimes what happens is a big company will give the work to another big company who turns around and outsources it to your company because you're better at delivering it, but they'll skim off all of the profits. And oftentimes it's 90% of the profits go to the company that's won the business. Scale paradox manifests itself in a whole bunch of other ways as well. Just at that point where the small business really needs to attract great senior staff. The problem is great senior staff, as much as they hate the corporate world and they say, I'd love to work in a small business, they can't take the risk of working in a small business because small businesses are inherently risky. Typically, you lose 2 key clients or 2 key staff members in a year. That could be your worst year ever. And good senior employees know that. That's why they'll stick with corporates. So small businesses lose the talent battle on a daily basis. Second piece was around the value creation. So this is why entrepreneurs would choose to join our model. Second piece is around value creation. If you've built a $10, $20 million small business, you're creating a huge amount of value in the world. You're creating massive value for your clients. You're creating huge value for the 100+ employees that you've got and their families. There's a whole ecosystem of suppliers and partners and landlords and everyone else that's extracting value from your business every day because you get up and go to work. Typically, there's only one person that doesn't get to extract the value from their business, and that's the founder, the owner of that business. It's very easy to put money into your own business, much, much harder to get that money out of your own business. And that's kind of, we signed up to that as entrepreneurs. We kind of signed up that, we'll do all the hard work now and we'll get paid off in the future. But eventually, one day you wake up and just go, hang about. Like, there's only so many times I can remortgage my house. Why is everyone else making more money out of this game than I am? And so then you start looking around at your options. And this is the bit that nobody talks about. When everyone's talking about how sexy and cool it is to become an entrepreneur, nobody talks about the exit. Well, they talk about like WhatsApp exiting and that sort of stuff. But the reason they talk about that is it's so rare. There's actually very few exits available for good debt-free businesses, profitable businesses. And so you start looking, well, what are my options? I could get investment and scale up and become a big business, but again, you've got that problem of who's going to invest in you. Private equity? Or do you want to lose control of your business and have your best staff fired? That's not very attractive. And so what ends up happening is a lot of companies will end up selling their company to a bigger industry player, a trade sale, because it's really the only option there. I mean, we have this kind of, as entrepreneurs, we have this idealized view that someone will give us a suitcase of cash and we can walk off into the distance, but it just very rarely happens. So you sell yourself to a bigger company, and immediately that bigger company starts telling you that you need to rebrand, you need to change all your employee contracts, you need to change all your client contracts, and you've got to hit these targets that you promised them. It's a 3-year or a 5-year earn-out in order to hit that. Anyone that knows an entrepreneur that's done that probably knows an entrepreneur that left within 6 to 12 months. Most entrepreneurs just cannot survive in the corporate world. It just doesn't work out well. And you end up leaving a huge part of the money behind. In fact, I spoke with the head of M&A for WPP, the big marketing conglomerate. And he'd been drinking, so he was quite free with his information. But he said, look, basically, if you're a small marketing company, you're doing £1 million in profit, we'll offer to buy you for 6 or 7 million, but it's based on you hitting targets over the next 2 to 3 years. Headline figure is 7 million. Internally, we'll write it down as 2 to 2.5 million that we actually expect to pay. I said, that's fundamentally unethical if you're going into deals like that. And he said, no, you entrepreneurs are fundamentally idiots. What? And he said, well, first of all, you always think next year is going to be your best year ever. Yeah, well, it will. And he said, and second of all, you make terrible employees. And I went, oh, yeah, okay. So it wasn't that they were being mean. It was just that in their experience, it just didn't work out the way everyone thought it was going to work out. So it's a bit of a grim scenario. And so basically what we came up with, what my business partner came up with, was this idea of agglomeration. We create this publicly listed vehicle. It allows good, well-run, debt-free, profitable businesses to swap their private stock for public stock, but the founder keeps operational control over their business. So it's their brand, it's their hiring and firing. Now, if you're an entrepreneur, this makes perfect sense. Yeah, of course, why wouldn't you do something like this? If you're a finance person, if you're an investment banker, or you live in the world of balance sheets, this makes no sense at all. Because you can end up with a company with 20, 50, 100 subsidiaries, each one with their own CFO. Well, that's nuts. You could consolidate the finance function and consolidate the sales function and rebrand everything. But of course, then you go back to an accountant telling an entrepreneur how they should run their business. And to an entrepreneur, if you trust your CFO, and your CFO might be your brother-in-law that you play golf with every single weekend, that's worth more to you than saving 10% and losing control of the money, the finance option. So this is kind of why companies line up to join an agglomeration. All sounds great in theory. We wrote a book on it. I don't have enough for all of you, but if you give me your business card, I'll send you a version of it. The first one we did, so we came up with this idea about 4 years ago. We did a version of this called the marketing group. It was a particular vertical. This was actually at the European NASDAQ in Sweden. We broke that bell. We rang it so hard we broke it. But it was very, very successful. We launched with 4 companies. We acquired another 13 companies over the next 90 days. The market cap of the business went from 14.5 million to 300 million. Our EBITDA went from 4 million to 19 million. Yeah, we had kind of billboards in Times Square, and it was all very exciting, and Forbes and all of that good stuff, because it was the fastest growing company. This is the size of a PLC. Yeah, PLC, yeah. So the share price went from €1 to €9.5. Now we're creating new shares to do every acquisition, but all of the acquisitions are being bought at a low multiple, and we're trading at a high multiple. So we've got the accretive nature of the profit that we're buying. So it grows incredibly quickly. Normally, the argument against acquiring so quickly is that you get what's called M&A indigestion. You try and merge through all these systems and cultures, it doesn't work. But in our business model, we swap shares and they carry on running the business. Now, unfortunately, what happened is when we got to that size, we were having a lot of very big companies come to us and say, look, we want to join as well. We want all the advantages of a PLC, but we don't want the cost associated, so we'll join. But we need some cash off the table. We need to buy out our PE partners, or we need to buy out our VCs or minority shareholders. And so we needed cash. And this is where our naivety came in. We found a fund in the US that offered us cash on terms that seemed too good to be true. And it was too good to be true. Where the bloke illegally dumped 3 million shares into the stock market. And so what that did, when you're a small company and somebody illegally dumps 3 million shares into the stock market, is that it crashes the share price. And so unfortunately, what we did is we kind of did the right thing. So for all those companies that had joined, we unwound them. So we then had to announce to the market that, okay, we'd acquired this company, and now we're unwinding a company. Ultimately, we ended up having to step down from the board. The company is still going, but in a very, very different format. Look, I know everyone tells you everyone says to you, don't lose $1 billion. It's really annoying. A quarter of $1 billion. It's a really painful experience going through that, so I don't recommend it. But everyone always says that their hardest moments are what they learnt the most from, and so we kind of licked our wounds. All of the companies that came in got out, and they were fine, because in effect all they've done is they've swapped their private stock for public stock. Nothing's changed for those companies. But shareholders lost a lot of money. We lost a huge amount of money. And so we had to kind of adapt the model and build the model, but fundamentally the model had survived the challenge. What hadn't survived was our trust in all of the investors. And so we got a lot more sophisticated in the investors that we work with. So this is our next vehicle. MBH Corporation originally stood for Multiple Business Holdings. It's since been rechristened Mini Berkshire Hathaway. As it's, we have a very similar ethos, which is find good companies and get out of their way and let them run. So this is relatively new. We launched it this year, started at a share price of €1 as a SPAC. Listed it in Germany. We wanted to be on the Frankfurt main market. For people that are interested, I can tell you why certain markets are better than other markets. We've backed in 3 companies. We uplisted onto the main market. We did our first acquisition after a month. We decided doing 19 in 3 months was a little bit excessive, so we're sort of doing 1 or 2 every month. Share price has gone up steadily. We just got a report came out yesterday morning giving us a price target of €2.5. And so basically that business, one of the biggest differences is we now do it as a diversified holding group. So rather than one industry, we have it as multiple industries. There's a couple of reasons for that. One is, again, to protect shareholders against downturns. But it also means that we can build a vertical in one industry and then spin that off into its own IPO if we ever get challenged again on the share price. So you can spin that off. So it's all about, this all came from how do you protect business owners and give them more options. So that's MBH. So let's go back to accelerated venture capital. So we did our first investment, and this was a relatively small amount, but it was just to prove the model. So on the 6th of December, last 3 months ago, AVC invested $500,000 into a company called Dubelet. Dubelet is an interior fit-out company in the UK, does really cool, it's a 20-year-old company, does things like Fortnum & Mason's restaurant shop fit-out, really high-class, very, very cool stuff. Great business, but they had clients wanting them to do stuff and they needed money to outlay first, so we put in $500,000 into the company. MBH then acquired Dubelet in a 100% share swap deal. Now, it did take us 2 days, which is incredibly slow. It's embarrassing. That should have been 2 hours, but 2 days is still not bad. So we did the deal. Now, this hasn't happened, but should happen within the next 2 weeks, is that Accelerated Venture Capital will be able to fully sell out of its position at more than 50% return. Yet the cash is still sitting with Dubelet. So Dubelet still has that cash to go out and use it. MBH has made the announcement to the market, so it's got the uplift in that. And AVC is able to take its cash off the table, so it's able to sell down its shares, and we arrange block buyouts to do that so it doesn't damage the share price. And then they can invest. They've now got, so if they started with 500,000, it's now 750,000, and they can invest that into the next company and repeat the model. And we have it's a 12-month term, so ideally we'd be looking to do probably 4 or 5 rotations, and it won't be the full amount. It kind of be, you might not take out all 100% on day one because it might force the share price down, but it allows you to rotate and compound that money, which means that as an investor in AVC, you get a very, very significant premium on your money, and your money's only locked up for 12 months. And the other thing is that you get full visibility of it. You get full transparency of what's happening with those deals. So that's AVC. David Dubelet had, like many investors, many entrepreneurs, he'd spoken to lots of other people and rejected them all. This was the model that he liked because he really cares about his family, which is the business, and he wanted his staff to stay. So really that's the way that we found to create alpha, to create like better than market returns, to have a positive impact on small businesses, and to give you liquidity. As I said to those people right at the very beginning, whether you think this is a good idea or model for you or not is kind of irrelevant. The point I want to make is that there are more entrepreneurial ways to approach both the ways you invest into companies and the ways that you get out of companies. So don't get caught up in sort of the traditional of, okay, I write a check and I say goodbye to it for 10 years. There are other options. And there are other options that can be entrepreneur friendly. And this is something that I think is often overlooked by investors. It's very tempting to think you know better than the entrepreneurs. We actually make a point. Obviously, we deal with a lot of small business owners. Many of them come to us for advice and say, look, we're at this stage. How should we do it? We're very deliberate not to give advice. Because it's very tempting to think you know better than somebody on the ground. So instead what we do is say, look, you've now got a peer group of entrepreneurs, very successful multi-million-dollar businesses in that group. Go and talk to them because they've got a vested interest in your success. And it also kind of absolves us of the blame if it goes wrong. So the more entrepreneur friendly you are, I think the better you get. This is the real reason why we're doing this. If you look at philanthropy right now, all of the most interesting stuff that's happening in philanthropy is being driven by entrepreneurs. It's not being driven by NGOs. It's not being driven by governments. It's being driven by entrepreneurs. And what we realized is that, and that's true for philanthropy in the past 400 or 500 years, it all gets driven by entrepreneurs. And what we realized is that the life of an entrepreneur is basically a change maker. It's a problem solver. You solve problems in your business. When you've solved the main problem of that business, you typically look at solving problems in your industry. And when you've solved problems in your industry, you tend to look at bigger world problems. The problem is, most people are pre-burial by the time they get to a point where they're in a... Oh, that offend a few people, sorry. They're elder. They're more mature. So what we're thinking is, look, how do we bring that back? If you think of the amount of brain power that entrepreneurs, the sleepless nights they have trying to solve problems in their business, if you can get them to a point of liquidity sooner so they can start thinking about bigger problems in the world, then we think you can make real changes. One of my heroes and somebody that's a great example of this is Richard Branson. He's built up an incredible business. His focus now is on cleaning the oceans and space travel, looking at bigger challenges. If he was smart enough to read our book, then you could be just like Richard Branson. I had to pay a very high price for that, which I'll discuss over beers later. But yeah, like I said, if you want a book, I don't have enough for everyone, but give me your business cards and I'll send you a copy. And that's it. Yeah, happy to take any questions. This started off with a really nice, cute group of about 5 people. It's now extended a bit. But Lucy, yes.
Very quick, 2 questions. What's your minimum entry ticket? And then are you sourcing most of your companies from the UK? Or all of them from the UK?
Yeah, okay. So entry ticket for the fund? Okay, so the fund was originally designed for big institutions, the idea being that they couldn't get into a PLC directly, so they could come through the ABC. Baybars being Baybars wasn't happy with that, and so insisted that we lowered it to 50,000 so that we could open it to angels. And even that grouped together with a few people if that doesn't fit your target. But yeah, so 50,000 you can get into the ABC fund. It's a 12-month lockup. Yeah, happy to have that conversation. Companies that we acquire are actually global. So we're a UK PLC. We're listed in Frankfurt. I'm based in Singapore, but the companies that we work with are all over the world. We kind of have a preference for English language, English rule of law, just because there's so much low-hanging fruit. There's so many mature businesses in those markets. But we'll look at any company. Ideally, what we're looking for is debt-free, doing between 1 to 5 million of EBITDA, typically owner-operated, but we'll look at anything that's kind of on the periphery of those as well.
Thank you.
Yeah.
You gave a case study where it said that the Laing or
Mhm.
whatever it was,
Yep.
so they needed 500,000, so you put that money into their business
Yep.
through acquisition. So does that mean that the company was fully acquired at 100% with that 500,000 and they're no longer shareholders?
Yeah, good. Okay, so forget the ABC for a moment. When MBH, so when the PLC acquires the SME, they acquire 100% of the stock. So it's swapping private for public. Typically, we do it on a relatively low multiple. So the way we structure it for the business owners coming in is they come in at a relatively low multiple, but every year thereafter, they earn more shares, the more profit they contribute. So it's a perpetual earn in. That's attractive to entrepreneurs because they always think next year is going to be the best year ever. But it also is very attractive to the market because we're seen to be acquiring these companies at below market rate. The way we do it is we do it as a multiple of EBITDA plus whatever's on the balance sheet. So if they had $1 million of profit of EBITDA, and then AVC invests 500,000 on the balance sheet, then what MBH acquires is 3 times 1 million plus 500K.
And then with that share swap with MBK,
Yep.
does that mean, maybe I'm mistaken, but does that mean that entrepreneur in company A gets those shares into MBH, but MBH has a portfolio of companies? So essentially that entrepreneur company A is not having share swap for 100% of his company, but equivalent share swap for the portfolio of companies.
Yeah, so when a company comes in, they get a number of shares corresponding to their profit contribution to the group. So what happens is they go from being 100% shareholder of their company to a smaller percentage holding of a holding company. And then over time, so the question that they always ask is, well, that's fine, but what happens if one of the other companies goes bust? No one has ever asked what happens if my company goes bust. There's always somebody else's company that's going to go bust. But basically, we said, look, it's going to happen. Small businesses go bust, bad luck or bad management, it will happen. Our job is not to go and try and fix that company or throw money at that company. We just basically write it off, because if you've got 4 companies in the group and one goes bust, that's a bit of a challenge. If you've got 30 companies in the group, it's a rounding error. But basically, rather than a big stick to stop people going bust, because I don't really think that works. Entrepreneurs don't kill their businesses out of spite. What we do have is a very big carrot for them to be profitable. So they get 3 times the additional EBITDA the following year. So if they did $1 million in profit this year, the next year they do 1.5 million. That 0.5 gets times by 3, and they earn another 1.5 million in stock. And so there's a lot of incentive for them to find ways to work with the other companies as well. One of the things that really bugs kind of traditional M&A with this model is traditional M&A is often built on, so that the roll-up and list model is kind of built on, okay, we overpay for these companies, we merge them together, and we make so much money from the synergies that we save. Synergies look fantastic on paper. They very rarely work in real life because people get in the way. So basically what we say, and look, one way to guarantee that synergies won't work is to force them to work. So what we say is, look, any company that comes in, you get to run your business the way you want to run your business. But if you want to go and share a CFO with the company over there, great, do it. But you do it on your time, and it's up to you, and you can split the profit how you want to split it. So it's much more, we find we get the best results when we give control rather than when we take control, especially with entrepreneurs. Yeah.
So in other words, you create a portfolio, something like a mutual fund. And the companies that are incorporating this portfolio are not at the silver or the seed stage, not even in seed stage, at a very later stage. But on the other hand, their financial demands are only at the stage of 500. Their financial demands are set at what stage?
So typically we tend to stay away from, most of the founders we work with wouldn't know what a Series A round was if it hit them in the head. I know. Exactly. Yeah. So what happens is even within that startup world, you've got the kind of the tech space and you've got small business and the other space. We tend to avoid tech. Basically, I have a very simple question when I'm talking to a small business owner, which is, do you read TechCrunch? If the answer is yes, then I politely move on, because they'll think they're going to be the next unicorn. So typically, we tend to work with very boring, old economy businesses. So actually, a lot of them don't even need funding. But what's interesting, and even if they think they don't need funding, what happens is the minute they become a PLC, they get over the procurement hurdle. A lot of small businesses don't even understand the procurement hurdle. So basically, as a summary, a big company will not give a small company a contract that's more than 1/3 of your annual revenue. That's procurement best practice. So often you'll go and bid for a contract, and you'll be the best deliverer of the value. You'll be the best price. You'll have the best people, and you'll still lose the contract, and you'll never know why. But it's because procurement has just ticked a box that says no, you're too small. We worked with one company, a lead generation company in Australia, that was working for Telstra, one of the big telcos there. Had been working with them for 8 years. Their biggest lead generation contract was $150,000, and they joined one of our agglomerations in July. In August, they resubmitted their credentials, and in September, they got a $1.5 million contract from Telstra. And the manager said, look, I've worked with you for 8 years. I know you can do this, but there's no way procurement would have let me give you the full budget up until now. So it's ridiculous. Like, nothing's changed, and they now had to scramble to try and hire headcount to deliver on it. But procurement is just a...
And your portfolio is protected by how many companies? 50, 30, or 100? So when somebody uses the money on a discretionary basis, the decided investor, he does he know, she know how many companies are incorporated or not?
So basically, of public record is that we intend to do 15 to 20 acquisitions a year. So every year. So that's a number that we're very comfortable that, yeah. Add 50, yeah. So we'll keep adding. So it's a buy and hold strategy. We don't flip these companies, we don't get rid of them. So we keep adding. Every year we'll add 15 to 20 more companies.
Sorry, I know you explained it. Oh, sorry.
No, that's it.
But I'm still struggling understanding how you create liquidity within the system.
Okay, so the holding company is a publicly traded company, which means that anyone can buy and sell the stock. Now, one of the challenges and why getting the right market is so important is that a lot of small businesses go public and then nobody trades their stock. For example, we're based in Singapore. We'd never do a listing in Singapore. It's just the market's not good for it. One of the advantages that we have as a business is that we're constantly making announcements. So pretty much every month we'll make an announcement to the market, and it's a significant announcement. We've done another acquisition. Very quickly you get to 10, 15 companies. You're hard pressed to go a week when one of those companies doesn't hire someone senior, or so you've got a lot of news feed. The bit that we focused on, so I mentioned earlier that we kind of ran into toxic debt and we ran into somebody that did something illegal. We spend a lot more time now in investing our time with investors. We like working with small funds that are patient capital, family offices that come from an entrepreneurial background, because these guys get what we do and they also want to see small businesses thrive. The first time we did this, everyone wanted to throw money at us, and we were like, that's great. So we took money from everyone, and that was a mistake. That was too much entrepreneurship in us. Yeah, cool. There's a question there. Okay, yeah. The other advantage that we have on the liquidity front, and we haven't yet got this kicked in because we wanted a relatively stable share price to do the first couple of acquisitions. But when you're a small business, doing an IPO is horrendous. It's like 12 months of hell and costs and lawyers, and it's just everything wrong with entrepreneurship. Once you get public, you've gone out, you've raised capital, and you have told the market that you're going to do amazing things next year, but you haven't done anything for the last year because you've been trying to do the IPO. You then have to go back into the business and try and do all your operations and get back to it. So you don't talk to the market. So basically, the last thing the market's heard is that you're going to be amazing next year. And then the first time they hear from you again is when you fail to hit your numbers 12 months later. Well, the advantage that we've got is that I have no operational involvement in any of the companies. I don't do any interior fit out. I don't look after children in the play centres, you'll be pleased to hear. I have no involvement in that. So I can spend all day, every day at conferences, talking to the media, talking to investors, living on a plane, and going around and doing that, which is an advantage that many small businesses don't have. I've got a suspicion that I'm running over time. So, yeah.
So it's just regarding this model with small businesses.
Yep.
So you mentioned that with this particular process, you're looking at small businesses that come together under one public company and they trade individually as still business owners.
Yep.
And the benefits are that they can say they're part of a multinational, I guess, a clean multinational company.
Yep.
So the issue that the concern that I've got with that is that if they are trading on sort of still standalone and there's no consistency because other multinational, they have the same brand, they have the same service, they have the same kind of business model,
Yep.
how would then that pan out to a potential client who says, you go out and say we've got 10 offices,
Yeah, so it's kind of basically what we do is we give them the option how much they want to use it. So the nice thing, because we don't rebrand everyone, they keep their whole brand because their brand's got trust in their community. So they can go to their client and be incredibly, we're bespoke, we'll look after you. But when they need to go for a big contract and they want to play the big PLC card, they can play that card. So it's really just up to them how much or how little they want to use it. One of the concerns from an investment standpoint on that is basically you're a conglomerate. So anyone that sort of followed investment, in the 80s, conglomerates really went out of fashion. They all got broken up and they're sold off for the parts were worth more than the whole thing. If we went out and told people we were a conglomerate, there's no way investors would buy us. If you say you're a diversified investment holding group, they go, oh, that's really clever. Hang about. Everything goes round in circles. Our view is two things. There's typically what's called a conglomerate discount applied to a portfolio of different businesses. Our view is that we get a fast growth premium because we're adding 1 or 2 million of EBITDA every single month, which far outweighs any discount. But even if we do get that discount, we can always spin one of the verticals off into its own IPO. So it's really like I guess the big distinction is if you think about it from the business owner's perspective, like how do you give them as many options without restricting them? Cool. I think I've overrun into another speaker's time. So anyone that asked me a question can come and claim a book. And anyone that didn't, give me your business card and I'll send you a book. And thank you very much for attending, and I'll be around for the rest of the day.